So one of the Z Trades members came in here on free trial. You guys got to excuse me. I'm sick right now. It sounds like I'm talking holding my nose underwater. He says to me, "Hey, I'm a beginner, just started out trading options. I've been watching a couple tutorials for Robinhood and thinking about a month-long put on NEO. NEO or NIO? Because of their earnings report coming up. What do you all think?" I hope he doesn't mean NEO. NEO. Uh, Maybe it is this one. Ooh, if it's not NIO and NEO, this thing has ran up quite a bit. Let's do some TA on this. I haven't traded these guys in a very long time. You don't know a lot about technical analysis, so I'm not really going to go into this, but there is a volume gap down here to 1820. And there's also a fat volume gap down here to 14, and volume gap, that is, and a gap down here to 16. So you might be onto something here. A nice little reversal candle up here. Let's go back over here to NEO. How would I play this? When is their earnings? Okay, the further out you go on earnings, when you choose a contract, this thing is beating earnings pretty much every time. That doesn't mean that it won't drop, though. It could still beat and drop. Well, it must be NIO you're talking about. So we'll just use this one. I don't know if you mean NIO or NEO, because I don't, they must have just had their earnings. I don't know. Anyways, let's just pretend NEO has earnings coming up. Okay? And it's going to be for, let's use NIO. That's probably what you're talking about. I don't know. But let's use NEO. We'll use NIO as an example, okay? Which, it's getting tight in this range. Probably not a good idea to buy a put when it's at a low that it's bounced at before, right? Bounced at literally almost the exact same price as it did before, when all the EVs ran pretty well. Probably not a good idea. I'm not going to sway you. This isn't going to be financial advice on what to do with your money. Now, before you play earnings, we're just going to pretend you're going to play NIO, okay? We'll go back. You said NEO, so we'll go back to that, okay? We'll go to NEO. That's the cryptocurrency. Let's go back to here. What would I do? First off, buy put. You guys need to come to the sell side. The real way to play earnings is a debit spread, a credit spread, an iron condor, a butterfly, or an inverse butterfly. That's the real way. Or a cash secured put. I wouldn't do that unless it's low, not something that's high like this. Okay? So, how would I play this if I were to do it? First off, we're going to have to go back to NEO over here. Trade options, okay? Buy put. NEO is their earnings is, I'm hoping that's what you're talking about. I'm confused here, and I'm sorry to jump back and forth, guys. NEO is November 30th. Okay? So would I buy an options that expires, buy, put? Would I buy an options contract that expires, November 24th, Friday? No, earnings isn't there. I'm not saying that you would do this. I see people do stupid stuff like this. Would I buy it for December 1st? No, because it's the same day contract at that time, at that point. There's extreme decay. The closer you get to this date right here, the faster the price of it drops. And I mean, it drops fast. Unless the stock is aggressively moving in a direction. If you have a put, it needs to be aggressively moving there. And if I buy a $5 put, it needs to be below that. It needs to go below $5 or down to $5 like that in a flash immediately on this date. And in that day, that contract is going to get obliterated. Okay? That only happens starting, closer. If I buy a contract for 2 months out, the decay is very slow. Right around a month to 3 weeks in, it starts to get very aggressive and drop very fast. So would I buy December 1st? No. You said a month out. I like that. I want it to be a month out from the earnings, not from today. Today doesn't matter. Nothing matters until earnings happens. So December 29th at the least. If the closer I'm going to go on the date, the more in the money I have to be. Okay? Keep in mind when you watch these YouTube tutorials and videos, they are going to be very confusing. They don't do a good job. They don't explain it in layman's terms, right? I don't necessarily want a bunch of new people in Z trades because it's very hard to manage them and it's very hard to watch. You're like, oh my gosh, what's this guy doing? We don't have time for that because we're kind of a team, right? We're all a team and we're talking about very advanced stuff. Now, that doesn't mean that new people aren't welcome. I will go out of my way, even if you're not a paid member, to get you up to speed to try to help you out. So don't worry about the break even. Don't confuse yourself. Don't worry about buying the shares. And I wouldn't personally ever hold an options contract on the buy side till expiration. You do that on the sell side. That's a separate video. I have information on that. You're not ready yet. What you need to do right now is the way you learn options trading, unfortunately, is to lose. It's to win and to lose. It's to hold something and watch it go to zero all the way till expiration. My very first options contract was a Ford call. And I bought it for $4. And I remember it jumping up to $5. And I'm like, oh my gosh, what does that mean? I made $1. Does that mean I was right? I didn't understand it. And I watched it expire. And I did it again. And I did it again. I was losing money. Did it matter? That was my tuition to trading school. And that's okay. What you personally need to do, and anybody needs to do, if you're going to touch options, expect to lose all of it if you're new. You're going to lose, expect to lose 100%. That doesn't mean you will, but you're probably going to lose all your money. Now, the closer in the expiration, the more in the money I have to be. What does that mean? That means it's not below the put strike, right? So $7, anything below 7.5, right, would be out of the money. So this is way out of the money. That's very hard for this to be profitable. This would have to go way below 7, right? In my opinion, so since it's not that far out, we're about a month out from earnings, since earnings is November 30th, I would be doing an 8, probably an 8 put to be safe, an 8.5 put. Deep in the money. Let's check the IV, the implied volatility. Implied volatility is what? IV 65. It's already getting up there. They're pricing in earnings now. The best options contract, not the best would be a February 8 or a 9, in my opinion. If you really believe it's going to go down, I personally don't think it is. I think it's going to pop a little bit or at best run flat and it'll be premium crushed. And I'm going to explain what that is in layman's terms in a minute here. Now, January 19th may be a bit better. The 9s look great and the 7.5s do not look bad at all. I like the 7.5s. That's right at the money. That's a little bit more risky than in the money. You think that it's more risky because it's more expensive, but there's actually going to be something to sell and to get back if you were wrong. There's going to be something there still, right? There may not be, if you did something like this, there's probably going to be, there's nothing there left by earnings. So, one other thing I wanted to explain here is NEO is trading at $7.51. Okay, you can see it right here. If it stayed at that price, if we bought this November 29th, earnings is November 30th, and earnings happen pre-market and the stock opens up and it didn't even move a cent. If this was $72, it would be worth about $40. If NEO moved down, let's say just a quarter to 725 from 751, this would go from 72 to about 50. And you're going to be like, what? This is a scam. I don't understand this. I don't know about this trading stuff. This isn't for me, right? This is rigged. I don't understand it. It went down and I lost money. Implied volatility. People are expecting it to go up aggressively or go down aggressively. So there's a premium on the contract. So if there was no earnings coming up, this contract may be worth $55. Well, now you're paying a higher premium for it because people are expecting it to go up very aggressively or down very aggressively. I'm explaining this in layman's terms so you can understand it, right? So the second earnings is over, their true face value is going to come back, right? Which would probably be around 50 cents, right? $50, 40 to $50. You're going to be wondering what happened here, premium crush. Now, before earnings, the closer we get to earnings, the higher the IV is going to go. And these contracts are going to go up in value even if NEO stays at the same price. They may end up going to 90 cents. They could go to $1, right? That would be where I would sell before earnings if I made money. Now, what's the best case scenario? Let's say NEO shoots down to $5. Do I think that's going to happen? I don't. It could. It absolutely could happen. Now, if that happens, you would have a fat payday as long as the expiration was far out. Because if it's a short expiration and then earnings is over, the premium crush on the contracts is insane. It is very bad, especially if you're not in the money enough. If you're deep in the money, you're going to be safe, right? So I'm just showing you, if I were to play earnings, how I would do it if I was positive it was going to go down. I have to say, though, you are gambling. Earnings is not 50-50. And no, trading is not all gambling. You can claim it is. It's a very debated thing. People can claim it's gambling. It's probability. And if the probability is around 85 to 90%, that's not necessarily gambling, in my opinion. And if it is, it's gambling with a high probability, and you're just playing probability, right? Which I can show you my portfolio. I do things that have probability of around 98% chance of winning, and I'll show you guys my Robinhood account on the sell side if you all don't believe me. I'm on the other end. I play Premium Crush, and I started this account with $1,000 just to show everyone what you could do. This is from April, right? So that Premium Crush we talked about, excuse me, guys, again, I'm sick. I'm making money on that because I'm the one selling the contracts, and people are buying them. I'm on the other side. This is how badly options contracts get crushed. I sell contracts that have high implied volatility, and I play earnings by selling them, not buying them, and it works out. That's too advanced for you. I can train you up, though, and I can teach you. I can teach you the sell side. I have videos. I ask you, I beg of you, actually, because I've got you before it's too late and you've accumulated a lot of losses. Please look at my videos. Look at the wheel. Look at the cash secured puts, right? Take a look at my channel before you go into this losing a lot of money. Now, again, I have to say it again. It's imperative that you watch an options contract lose. Have a losing play. It's imperative, and it's imperative you have a winning play. Whatever money you put in, write it off as a loss because you're probably going to lose. Playing earnings is not profitable. It's not going to work. I did it when I started. I played calls on stocks. I played puts on stocks. I bought both. Out of the money, at the money. I did straddles, strangles. It never works. It never, ever, ever, ever works. You may win 1 out of 10, but that would just make up for your losses. And in fact, the most money I made was on long swing trades when a solid growth stock had just been hammered, and I bought a nice options contract a year out, and I held it. That was some of the most money that I made when I was new, right? It's different now in the different strategies I use for trading and making money. So take a look at the sell side, see if you can do that. Don't confuse yourself. I try to make videos is in layman's terms and as easy to understand as possible. This is why I'm always pausing and I'm thinking about how to explain it in another way. So buying an options contract, we got a minute left on this video. To sum this up, I would trade NEO if it were me picking it. No, I would not do December 29th. If I would, a shorter expiration, the more in the money I would need to go, right? I would have to get the 8.5 or the 9. The further out the expiration, I could go a little bit maybe at the money, the 9s or the 7.5, since that's where it is right now. And again, if it were me and I had to buy this put, which is maybe a learning experience for you, before earnings, if this thing is worth more money, I would take profit. And then I would look at the options contract and pretend I was in it after earnings to see what happened to it. If you guys like this content, please like and subscribe. If you want a video for you, come in the Z-Trades Discord and just simply ask me.